This video covers some of the basic concepts associated with accounting depreciation. Throughout the semester, we'll talk in more detail about accounting depreciation and some of the methods that are used by businesses to recognize depreciation expense for depreciable assets over time. But this is just kind of a initial look at accounting depreciation to get us started. So. Accounting depreciation is how businesses recognize the expense associated with a long-term asset for the current period in cases where the asset is long-term and is going to last for multiple periods, multiple years, multiple reporting periods. The rules by which businesses utilize depreciation, recognize depreciation expense, are defined by the tax code. So what that means is the tax code will define the length of time over which the specific asset can be depreciated. That might mean it's a 5-year asset, a 7-year asset, a 10-year asset. That's often also referred to as the useful life of an asset. And those are typically designed to try to match the length of time that an asset will typically be used. So as an example, if you have a piece of equipment that we typically think of lasting 5 years before it needs to be replaced, or it needs serious maintenance associated to keep it running after that time, it might be assigned a 5-year useful life for depreciation purposes in the tax code as well. Now there are constant changes to tax rules, and there's often temporary exceptions that might allow business owners to deviate from depreciation rules. Examples might be that for a certain tax year, businesses might be allowed to more quickly depreciate assets than would usually be the case in the permanent tax code. And so those issues can come up, and those things are constantly changing. The other point I wanted to make about accounting depreciation is that this is something separate from economic depreciation or appreciation, which refers to how the market value of an asset changes over time. So as we'll see in a few minutes here, through the example of how an accounting depreciation schedule might work and what it might look like, accounting depreciation is purely how a business recognizes the expense associated with an asset over time, whereas economic depreciation or appreciation refers to how the actual value, the market value of an asset might change over time. So we can see market values increase for some assets over time. That would be economic appreciation. We can see market values decline for a lot of asset types. That would be economic depreciation. But that's something totally separate from accounting depreciation, which is just simply how the tax code allows business owners to recognize the expense over multiple time periods that is associated with these long-term assets. One other point I wanted to make before we see an example of a simple depreciation schedule is how accounting depreciation works and how it impacts the income that is taxable for a business. So we often think of accounting depreciation as being a tax shield for business owners, and that's because accounting depreciation, again, is recognized as an expense over time that has the effect of reducing the taxable income that a business owner will be subject to pay in any given period. And so that's why we refer to accounting depreciation as a tax shield. Now, this, it's again, as we'll continue to work throughout the semester and utilize depreciation expense, work through different types of depreciation methods and schedules, I think this will become more clear. But a key thing to understand about depreciation is that depreciation is simply taking the expense that is made at the time of purchase and spreading that out over time for income calculation and tax purposes for the business owner. So when a business buys a long-term asset, they obviously have to pay for that asset up front. They may use loan financing to do that, but they have to come up with the money required to cover the purchase initially when that purchase is made. However, they're not allowed to take that full purchase price as an expense all in that first period. The depreciation schedule spreads that expense out over time. Another thing that we typically talk about when we look at accounting depreciation is that business owners prefer to depreciate things as quickly as possible or as quickly as tax code will allow. And there's a couple of reasons for that. First, at the end of an asset's useful life, again, you can think of a piece of machinery or equipment if it's easier to think of a more concrete example. But if a business owner uses that for 5 years and then wants to replace that piece of machinery, they will sell it. And if that asset is sold for something that's different than the asset's current book value or tax basis, there may be taxes on that. So for example, if the market value at the time of sale is greater than the book value, that would generate income that would be subject to tax. Now, since $1 in the future is always worth less than $1 today, business owners prefer, in general, to defer taxes into the future as far as possible. So that kind of creates an incentive to depreciate items as quickly as possible. So even if you depreciate something quickly and that ends up leading to a tax on a gain from the sale of that asset in the future, a business owner always prefers to do that because they're saving tax dollars now with the extra depreciation expense, even though they might have to pay tax on income when they sell that asset because they depreciated it so quickly at some point in the future. That's always a preferred thing, to pay taxes later rather than pay them now. Another issue related to that is that the income tax that is deferred by depreciation expense is typically at a higher rate than what a business owner would be required to pay on a gain from the sale of an asset. So we've talked about this a little bit in class, and again, we don't want to get too far and deep into tax calculations, but taxes on capital gains, so a gain resulting from the sale of an asset, are currently and historically have been taxed at lower rates than regular income tax. So depreciation shields the business owner from income tax, which may be at a 25%, 28%, 30% marginal rate, whereas the gains on the sale of an asset, a capital gains tax, would typically be a lower rate, maybe only 15% as an example. So you'd always prefer to pay 15% on capital gains versus avoiding the 30% rate on income. Okay, so now we're going to look at a very simple example of an accounting depreciation schedule and how the depreciation expense, or the expense, might be recognized for a long-term asset through that depreciation schedule over time, how that affects accumulated depreciation on an asset over time, and then how the book value of an asset based on that depreciation schedule and accumulated depreciation over time will change. So again, a very simple example, we're going to think of a piece of equipment that is purchased by a business for $100,000, and we're going to fully depreciate this asset. So all $100,000 will be recognized as an expense over multiple time periods. And we're going to think of this equipment being defined as a 5-year asset, so it can be depreciated over a 5-year period. And we're going to use the simplest depreciation method, which is the straight line method. So we take the total depreciation expense that we have, which would be $100,000 in this case, and we depreciate that equally over the 5-year useful life of this asset. So based on that straight line method, the 5-year period, and the $100,000 in total expense that we have to spread over those 5 years, this example would result in the depreciation schedule that you see here, where every year the business owner would be taking $20,000 in depreciation expense over that 5-year period. So again, over time, we're expensing the entire $100,000. We're just not allowed to do it all at once when we purchase the asset. We have to do it over the 5-year period, and we're spreading that expense out equally here, $20,000 per year for 5 years. So how does this affect accumulated depreciation for the asset and the book value of this asset over time? Well, first let's take a look at what happens during and at the end of year 1. So again, first year, the business owner will claim $20,000 in depreciation expense. At the end of the year, that means that for this asset, the accumulated depreciation, the total depreciation taken up until that point will be $20,000. And that will reduce our book value from the original cost of $100,000 down to $80,000. So at the end of year 1, this asset, for tax purposes, is now worth $80,000 because we've claimed a total of $20,000 in depreciation expense through the first year. At the end of year 2, or during year 2, we would claim an additional $20,000 in depreciation expense. And then at the end of the year, that would bring our accumulated depreciation to $40,000, reflecting the $20,000 claimed in year 1, the $20,000 claimed in year 2. And our book value would be brought down another $20,000 relative to the year 1 book value. So we'd be down to $60,000. Again, reflecting the $100,000 original cost and then subtracting out the accumulated depreciation at the end of year 2 of $40,000 brings us to that $60,000 book value. And then completing this simple depreciation schedule using that straight line method, you can see what years 3, 4, and finally year 5 would look like in terms of accumulated depreciation and the book value of this asset. So in year 3, we take $20,000 in depreciation expense. That increases our accumulated depreciation on this asset to $60,000 and reduces our book value to $40,000. In year 4, another $20,000 in depreciation expense increases our accumulated depreciation on this asset to $80,000, reducing the book value to $20,000. And then finally in year 5, the final installment of depreciation expense, if you want to look at it that way, of $20,000. That means we've now fully depreciated this asset. The full $100,000 has now been expensed, meaning our accumulated depreciation is $100,000, and our book value then is taken down to 0 at the end of year 5.